Good evening, and thank you all for coming. And thank you all for coming to the first annual Mayar Capital Partners meeting, the Al-Khobar edition. This is our agenda for the evening. So I'm going to have a few brief remarks. I won't bore you for too long. And then we'll jump into Q&A. We've received dozens of questions via email. And so we've compiled them. Some of them have been combined. So we're going to do one question from the ones we got via email, and one question from the floor, back and forth, until about 6:30. At 6:30, I'm going to have some closing remarks. And then we'll either close or break for Maghrib, depending on if there are any other questions left. But that way, we don't have to take a break mid-session for prayer. So basically, we should be done by 6:45 or so, but I'll come back. If anyone has questions, please feel free to come back and ask them. I'm going to start by thanking the Mayar Capital team for everything that they do, day in and day out, to make the magic happen. I've been blessed by a team that is not only very competent, but also extremely pleasant to work with. And I feel extremely lucky for that. So I'd like to thank them, and I'd like to extend special thanks to Sophie for organizing the London and Al-Khobar editions of this meeting, and to Zamil House for hosting us this evening. I'd also like to thank all the people who work in the background, our partners in custody, brokerage, legal, compliance, the people who are often forgotten and not thought about, but they are the essential plumbing, essentially, for what we do. We have grown. 6 years ago, I was working from a tiny office by myself, managing $1.84 million. And just to illustrate how small we were, the fact that I'm mentioning the 4 after the 8 tells you. But we've grown to more than 50 investors today and more than $55 million of assets. Substantially all of this growth has been through word of mouth and referrals by people like you. So thank you so much for that. I really appreciate it. It's my preferred way of meeting new partners, and it makes me feel amazing that you trust us enough and are happy with your experience so far to refer other people to us. And there's more to come. I'm happy to announce today that we've just signed an agreement with Diraya Financial, and we've gotten the approval from the CMA to distribute the Mayar Fund in Saudi Arabia together. Diraya has been amazing. A couple of them are here in the back of the team. They've been amazing helping us go through this journey, and so we are very excited by the promise of this partnership, and we look forward to similar partnerships that we've explored and are exploring in other geographic markets globally. Since we started, I believe our success, all of our success, has rested on 3 very important pillars. The first pillar is our partnership principles. And so in our partnership principles, which, as you all know, we put on the first page of every letter, every report that we send out, we are basically promising you 4 things. We're promising you that we are going to communicate with you in a way where we are bending backwards to be extremely honest and transparent. The second promise that we're giving you is that we're going to align our interests with you. The third promise is that we are going to keep focusing on the long term and are willing to sacrifice short-term results in order to achieve that goal. And the fourth and very important promise is we will always look at risk before. To do here, essentially, I'm sorry if the text is small, but we're going to send this out later on. What we're trying to do here basically is think as business owners. Let's look at the underlying companies that we own through the fund. Let's see where they're generating their revenues. Let's build up from there, and let's see we as owners, what kind of geographies are we exposed to. And we track this on a quarterly basis. And what you can see here is that we've had a very diversified portfolio since day one. We continue to, and we'll address the spike in cash in a couple of minutes. But we continue to think of ourselves as business owners that own assets all over the world, that generate revenues for us as owners through these things that are legal entities, which are companies that ultimately become stocks that we own. More conventionally, this is our portfolio geographically from a listing point of view. The key thing that I want to highlight, which is why I'm putting this slide up, is you can see the red line is our North American exposure. You can see that our North American exposure, mostly to the US market, has peaked at about 82.7% 2.5 years ago, and is now, this is as of the end of July, it's actually slightly lower now, a low of 46.5%. Now, we are not sitting around and trying to decide how much we should own in US stocks. Instead, this is the byproduct of our investment process. Our investment process is coming up with things to buy and also coming up with things that we should sell or reduce or add to. And a lot of it is driven by valuation. So the valuation discipline that's baked into this process caused us 2.5 years ago to start selling out of the US market. Now, it was probably too early, but this is the cost of being conservative in terms of valuation. Now, the other key message to take out of this is you're not buying someone or a fund that's trying to mimic the geographic exposure of the MSCI World Index. We are active managers in every sense of the word. We will go, we're going to look everywhere around the world. Sorry. I don't know how low I can go. We're going to go all around the world looking for investment opportunities. And if that means that we're going to have our exposure to the North American market because the opportunities are in Europe, then be it. The other thing that I want you to notice here, which is the gray line, the bottom one, which is the cash component of the portfolio. And again, we are not sitting back and saying we want to increase cash or decrease cash. Again, what we're trying to do here is we're looking at our investment process. We're getting answers from it. It's telling us to sell X, buy Y. And there are periods when there are more opportunities coming up for buying, and there are other times when there are more things that are coming up for selling. And it's at the intersection of these two things that you should expect our cash to either increase or decrease throughout the market cycle. And so instead of thinking of it as a decision that we've made, you can think of it as something to read about what the investment process is telling us about the status of valuation in the market. So basically, our process is telling us, well, some opportunities exist, they're not abundant. Now, it says this is the monthly number, which ended at 16%. It actually peaked twice at 18%, once 2 weeks ago and once in June. So there are still some opportunities. We've been able to still deploy some capital back into the markets, but the opportunities are not as attractive as they were, say, in 2014, 2012, or 2011, when you can see from the chart that our cash was essentially zero. And this is our industry exposure, and basically what you should take out of this is that we have broad industry exposure and sector exposure. This is what the portfolio looked at. It's in the annual report, which we've already sent, and there are some extra copies, I think, on the tables. Fundamentals. So now, this is a look through and what the portfolio looks like from a fundamental point of view. And you can see from this chart, this is a 5-year chart. You can see that from a PE ratio point of view, a price earnings multiple, our portfolio has essentially more or less been as expensive in a classical sense or slightly more expensive than the MSCI. Now, when you look at it from a free cash flow basis, our portfolio has been slightly cheaper, more cash generative, or similar to our benchmark. However, when you look at the underlying returns on equity of the businesses that we own, you see a massive difference. And by the way, this is skewed by the scale. The gray one goes into negative. And so you're talking about returns on equity that are 1.5 to 2 times the MSCI. What does that mean? What that means is that we're essentially trying to buy significantly above average businesses, but we only want to pay average prices for them. And that's essentially tying it back to what we said earlier, the core of. Now let's jump into Q&A. If you don't mind, I'm going to sit for this section. I want to start with 2 questions that we got via email, and then we can do a back and forth, all rolling, and then we'll do one-on-one. Yet at the same time, you do not share deep level thinking on holdings. Can you reconcile that? And why is it important for you not to share thinking on holdings? I think this is an excellent question. And there are 2 big reasons why we do not share a lot of details about our holdings. The first, and perhaps the more important reason, is behavioral. So studies have shown that when you publicly talk about a position that you hold, whether it's an investment position or an opinion about a topic, the more you talk about it and the more details you provide, the more biased you become more biased positively in this case, about this position. And there are many factors that play into it, mainly something called the endowment effect. But the idea is you fall in love essentially in one sense or another, and to save face, even slightly, makes you less likely to change your position and sell something if the facts change about it. And so we want to be in the famous Keynes camp, where if the facts change, we want to change our opinion, and we don't want to be biased against that. If things change, we want to be able to sell on a dime, essentially, without fear of anything happening inside our heads. The other reason why we don't share a lot of details about our positions publicly has to do with a problem that we don't necessarily face now, but we'll definitely face at some point in the future. And that has to do with liquidity in building positions or getting out of positions. And so we're still relatively small relative to the sizes of most of the things we invest to. But at some point we won't be. And if people knew what we were buying and selling, we may end up paying slightly higher prices to buy and end up selling at slightly lower prices than otherwise. And while it doesn't impact us today, we don't want to engage in a policy on day 1 or day 2 that we'd have to change on day 10 because of changing circumstances. And so just to be consistent, since the beginning, we've stuck to that policy. I want to take one more question from emails and then throw it to the floor. So 2 questions that we combined into one because they were similar. What is the biggest risk that you see to the portfolio today? And what keeps you up at night? And should we be worried? You should expect me to be worried all the time, right? That's my job. I think in the short term, the biggest risk that we face is the risk of underperformance. As you've seen, our cash position has increased substantially the past year and a half. And at the same time, markets continue to go up. Now, our portfolio has managed to still more or less track the benchmarks despite that. But there's no guarantee that that is going to continue to be the case. And as our cash, and like I said, if markets continue to go up and if valuations continue to go up, we may find ourselves in a position either through sales that we will do because of valuation discipline, or in a couple of cases that have already happened because of acquisitions of companies in our portfolio, we may find ourselves in a year or two from now with a much more expensive market, fewer opportunities, and a lot more cash on hand. And a journey between now and then where we've underperformed, a market that's gone from mildly expensive to very expensive to potentially crazy expensive. And history tells us that could happen. So there is a short-term risk that might happen to us over the next 12 to 24 months. That being said, at that point in time, we'd be sitting on a lot of cash, facing a market that's very expensive, having spent 24 months digging through every part of the world to find exciting opportunities that we want to invest in when prices collapse. We will probably outperform massively on the downside because of the cash, and we'll be ready to jump in and take advantage of those opportunities at that time. So while it's something to worry about in the next 12 months or maybe 24 months, it doesn't keep me up at night thinking over the next 5 years. And as we've said in our partnership principles, we'll ignore the short-term, focus on the long-term. The other risks that do worry me have a bigger impact outside mere monetary things. So the world has and continues to be a turbulent place. Perhaps we are in a position with a couple of cases where it could potentially end up in an even worse place for humanity. And I think the biggest and more worrisome loss will be human as opposed to financial. Think North Korea, think of what's happening other places around the world. I think that's the thing that worries me the most and keeps me up at night. However, this is an excellent paragraph, and it's long, I apologize. I'm just gonna read some parts from Bill Nygren, who's the fund manager of the Oakmark funds. And this is out of his 2016 annual letter. So the Oakmark funds at the time were 25 years old. And he said, over the past 25 years, a prudent, smart individual could have found many reasons not to invest. And he starts by saying Operation Desert Storm, the global recession that followed, Hillary Care, the Oklahoma City bombing leading up to 9/11, Iraq War, Afghanistan, SARS, global financial crisis, Brexit, European crisis, on and on and on. However, over those 25 years, the market has gone up by 9-fold. So someone sitting at any moment in time trying to think of reasons why not to invest could have found one. The trick is to actually figure out which risks are going to be key to either a positive or negative performance. Because risks can also be positive. Risks create opportunities, or perceived risks at least create opportunities. As long as you're properly diversified, as long as you don't go in all at once, as long as you're doing the right thing, I think if you have a long-term horizon, the time to not invest is almost never. So let's throw one to the floor, and then we'll go back and forth. There are 3 microphones, I think, on the tables.
I have a question. Return on equity calculation is fine. Have you book value of equity or the acquisition price?
This is the return on equity of the underlying companies that we own. And I'm using it to illustrate the quality of the businesses.
This is book value of equity as per the financials of these companies.
Yes, yes, yeah.
Your purchase price.
No, it has nothing to do with purchase price. This is just used to compare the average stock in the benchmark versus the average stock in our portfolio, and to highlight how much better our companies are as businesses.
My next question, well, in style, I think I know it well, all about value investing. Do you think by ignoring the growth, you're leaving money on the table? يعني أنت I think you characterize it as risk, and the market could outperform at some point. That we can call things are expensive that I'm not going to catch. But the other school of thought will say, no, these are growth stocks. It behooves you also to get some part of that action.
Excellent question. Let me jump because there's a question that's similar. So I wanna combine them. So this question, which we got by email, which is essentially the same thing or similar. It says Buffett recently admitted to having gotten Amazon wrong. What stocks do you kick yourself over? Now we don't have all day. I could keep going on and on. And it's now cool because Buffett said he missed Amazon to say, I've missed Amazon. Every value investor is coming out and saying, I've missed Amazon. I don't think I've missed Amazon. I don't think I was in a position to invest in Amazon. I've looked at it time and time again, and I couldn't figure out how much Amazon was making, and so couldn't figure out how much it was worth. And so for me, if I can't figure out what something is worth, I can't invest. And I'm happy with that. We have a poster at our office that reads, no FOMO, no fear of missing out. And we talked earlier about our investment process, and we're trying to kill the idea quickly, right? It comes at a cost. Being happy to say no quickly is not free. The cost of that is that you have to accept that you're going to miss on some opportunities, knowing that that's the case. Essentially, the cost of avoiding mistakes of commission is that you will also commit mistakes of omission. And you can't beat yourself over that. And there are many ways.
It's not bad investments in this time. And just because they're in a growth bucket, it doesn't mean that.
No, they're not necessarily. They're just not for us. It's an issue of knowing what you want to do, knowing what you think you can do well. And there are excellent growth investors out there. I don't think we have the skill to do it. Now, that being said, we're also not classic value investors. I think this is, as there was a question about this, we are on the quality spectrum in terms of value, and we do end up, as you've seen in our reports, owning companies that do grow quite quickly. Our second largest position is Alphabet, Google, which we've owned for 6 years. So we do end up owning some names like that. But we want to own them when we have a good handle on how much they're worth relative to the growth potential. And we don't want to overpay for that growth. But there are people who are happy to overpay or pay for the growth if they can have enough confidence in it. We don't.
And you don't want to acquire that capital, like higher end specialists. Essentially, Mayar, that caters to.
I think it's a personality thing. I think some people are born to be value investors, and some people are born to be venture capitalists and growth investors. I really think the distinction is a personality trait. It's not an acquired skill. Let me take one from here, which is probably why you're not good at it. So many industries, including ones you're invested in, are facing accelerated disruption. How do you position the portfolio for that? I can think of 3 industries where we are invested that are facing accelerated disruption. Retail is one, the packaged consumer goods industry is one, and media is also one. Now, there are many things to focus on, I think, here. One is that, yes, it does seem that there is an acceleration of the pace of disruption. Now, what's really interesting, I think, is why and where this disruption is coming from. Now, we believe that there are a lot of reasons why part of that is going to be structural and the other part is going to be cyclical. On the structural side, there are many barriers to entry to starting a business that have come down. You can plug into a lot of platforms now. You can start a business online or create an app, and you don't have to build the retail channel to sell the product to people. You can build it on Amazon Web Services, or we prefer you build it on the Microsoft Cloud. But you can do that without having to put up the capital to acquire servers and build up the plumbing, essentially. And so the barriers to entry have definitely come down. The other thing that we think is the other thing is that since the financial crisis, quantitative easing and loss of capital substantially for a lot of businesses, to the point that I believe today a lot of startups and smaller companies face an effective cost of capital that's almost zero. Now, what does that do? That creates an environment where a lot of people want to enter a business. It also creates an environment where a lot of people are going to enter an industry and engage in what I could describe as uneconomic behavior, where you give away a product for free without worrying about making money to fund that almost non-existent cost of capital. And that accelerates disruption, causes incumbent service providers to essentially go out of business, and then new players to come in and displace them. The problem here is interest rates may not remain low forever. They've already started to come up. And as they come up, you end up with industries where the old players have been displaced out, the people who actually had the business model, with new players that do not have an actual business model or even a revenue model in many cases. But now they suddenly have to make money. And so while the consumer may benefit on the short term, there is a potential long-term cost to these services getting provided by people who are not engaging in economic behavior. And I don't think anybody knows what's going to end up happening in that situation. Or it's very unlikely that the older players are going to come back into the industry. And I wonder if the newer players are going to end up figuring out a way to provide the service with a different revenue model to consumers when consumers have gotten used to getting the service for free. So I think it's something to keep an eye on. Now, from a portfolio perspective, from an investor perspective, what does that do? What that does is three things, I think, for us. One, it means we have to simulate the future, create many more scenarios than we used to have to do in the past. We have to think about what could happen to every company in many different scenarios. And we do that. We actually run simulations to try to see possible futures for every company. The other thing that we do to deal with it is that we would probably and do end up sizing positions smaller than we would have done in an alternate world where the disruption is not happening. The third thing where it impacts how we invest is that we think a lot harder about the interaction between the different parts of the portfolio and the different industries and how they correlate, given that many of the factors underlying this disruption are macro and impact multiple industries at the same time. And I think that is how we deal with it. And sometimes it means we walk away and say no faster, and sometimes it means we ask for a fatter margin of safety, cheaper price. Take one from the floor. Hamid.
The agreement with Diraya is more of a retail about hot money going in and out and changing the overall. Your AUM could go up and down very quickly overnight.
Yeah, excellent question. The Diraya agreement is for high net worth individuals and institutional investors. So Diraya is not selling the product is designed and licensed for professional investors, sophisticated investors. And so it's not targeting the retail market. There's a question that's going to come back later about the potential launch of a UCIT fund, which is retail oriented. And if and when we do, it will be in a separate vehicle to address that concern.
Maybe you need to mention this in the future when we talk about that.
Okay, thank you. Let me take one from these and, okay. How much cash do you typically hold and how you decide that? I think I ended up answering that just a couple of minutes ago. So let's take one from here.
Sure. In regards to the geographic slide, I think number 14, it shows that we're down from the US and we increased in Europe. Is that how you feel? In Europe, the opportunities are more currently, and in the US, it's becoming riskier a bit?
I'd invert it and say that's what the process is telling me to feel. The way we're running it, we're looking at all the different opportunities everywhere in the world. And at times, more opportunities will be attractive in a risk-adjusted way in the US, for example, and at times it's going to be Europe. And what we've noticed the past 2.5 years is that we still find US opportunities. But we found probably 2 to 1 as a ratio, European new ideas versus US-based ideas. And so the byproduct of that is that we ended up selling more things in the US and buying more things in Europe. And so we actually learn from the outcome as opposed to dictate the outcome. Let me just do one and one. Well, I also answered this one, so let's go to you.
So lesson learned. I have a couple of questions on the process. When we say we begin with the universe and try to be unbiased, we are biased by the development of the US market. So how do you ensure that you cover the tens of thousands of companies? Do you have an automated way that looks at all of these companies, especially when you include Asian and others, and then that will allow you to filter for the first two, and if not, then it's biased by your background. The second part of the process, when you say it's an understandable business, that's not an objective measure, that's a reflection of your background. So given your background, which segments are you excluding because they're not understandable to you and your team? Third, when you look at the price and you say it's too many questions.
No, the hard ones.
Look at the price. The last is easiest. What's the average price did you get in the market, and how does it compare to the average market price at the time? So when you say, let's say I invested in 2017, I injected $10 million, was the average I'm getting at a multiple? P2, was it 10 in the market, MSCI was 13, or was it 13 and the MSCI was 13, but for the companies it should have been more than that? So
Okay.
what's your average entry price?
Okay.
Do you need to summarize them? Or
No, I wrote them down. So, in terms of, can I take the last one first? On average, as you've seen from...
but that's the valuation today, not the entry valuation.
That's an ongoing basis of all of the
I'm
portfolio.
asking the entry valuation, not the current valuation. I've seen it.
Okay.
Entry valuation.
Okay. So, I don't have the detailed data. But at I think in the 2016 annual letter we talked about essentially 2 kinds of investments that we like to do. And we call Aubrey, in Aubrey's section, he talked about that. One he called the generals, and one he called the specials. And the generals are essentially wonderful businesses that are trading at reasonable prices. And their specials are in many cases either classic, very cheap value investments, or asset plays where there is an underlying asset that's not being reflected in the price. So the second group, the specials, would be a lot cheaper from a purely multiple point of view than the first group. I will tell you that it was a lot easier to find the first group, the amazing businesses, at a very cheap price in 2011, for example, than it is today. That being said, the multiple itself, in our opinion, is extremely misleading as a true test of value. Some businesses are worth a lot more as a multiple because of, we addressed this, the idea of growth potential, how wide the moat is and how strong they are in terms of a competitive advantage. And those deserve and should trade at a higher multiple. And so at any moment in time, the proportion of generals, where let's say we're paying average market multiple for way above average companies, and the specials, where we're paying substantially lower multiples than the market, will change. More the past couple of years have been on the specials than the generals. I don't know if that answers it. We end up often paying higher multiples than the market for some of the positions, and we're happy to in some cases. And we've added to existing positions at multiples that are 20, 30, 40% above market when we felt that it was warranted. But for us, we are looking at it from a risk-return point of view, and where the risk-return made sense, and even the valuation made sense. A multiple is just a shortcut. We would rather dig deep into having a deeper understanding of the valuation itself. Now, the two other questions, the bias that comes from how we end up selecting our universe, in a sense, in a very strict sense, you're right. In both ways. We do use a lot of mechanical screens in narrowing down our universe. A lot of those are driven by, we don't screen for valuation. So we look for companies regardless of valuation. We never screen because the PE is cheap. As you've seen in the process, valuation is the last step. So we are screening for business characteristics that are inherent to these companies. Things like returns on equity, returns on capital, free cash flows, gross margins, things like that. And those, in a sense, do introduce a bias to the process in the sense that we are not looking at every potential investment. So by trying to figure out our own little corner of the world, not geographically or by industry, but by the economics of the business, we, in a sense, are narrowing down
That's fine. That's not about narrowing down, but you apply that mechanical on all
geographies.
All geographies, all the companies.
Yes.
So it's just an automated, and the result is small enough for you to actually look into.
Yeah, there aren't a lot of companies that I would call great, substantial.
How do you see the specials?
The specials often come to us through 13Fs, which are listings of what other people are doing. Often the specials are companies that used to be great, that are falling through hard times. Sometimes we, by accident, read about it in the newspaper, and find that there is something hidden that someone is missing. I mean, a good example of what is now a special, actually, is Nordstrom, which we've taken to one of our top 5 positions this year. And Nordstrom is a company that we've owned and off and on between a tiny position and a full position since 2006. So, and I've been following this company since probably 2000. Now, tying back to the question earlier about disruption, retail is undergoing, U.S. retail globally, but the U.S. is the extreme case, is undergoing massive change. Department stores and otherwise, but apparel in general, and retail in general is undergoing a lot of change. A lot of it is driven by Amazon, driven by what's happening online, and a changing landscape of the malls becoming less relevant, etc. So a lot of factors. And so Nordstrom and Macy's and Saks and Kohl's and all of those, but also, as I'm sure you've heard, the grocers are having a hard time keeping up with Amazon and others. Now, 10 years ago, Nordstrom, which is managed by, the Nordstrom family owns just over a third of the company, and has, in my opinion, one of the best management teams in retail globally, and one of the best capital allocation track records in any industry. So 10 years ago, they came out and said, listen, the next 10 years are going to be really hard. We are going to take a substantial amount of our net income over the next 10 years, and we're going to invest it in building what we believe will be the premier online platform, actually an omni-channel platform for retail. And that means that in the next 10 years, you as investors are going to make a lot less money than if we ignored this threat. But if we don't do it, 10 years from now, we may die. So will everybody else in retail. And 10 years ago, and over the past 10 years, they have built what I think is the best omni-channel retail system in the US. They have gained market share, not only from their competitors, but from retail in general. They have pioneered a disproportionate amount of omni-channel basically use cases and technologies where they figured out very early on that having the asset base there is actually something that you can turn into advantage by marrying it with the online presence. Hey, without getting into too much detail, today Nordstrom gets almost 1/3 of their sales from online, more than any other retailer. They have captured massive market share versus their competitors. And they are very well placed compared to everyone else. Whereas Macy's and Saks and others are suffering because they did not start investing until 2 years ago. And they didn't do a good job at it anyway. So when the market brought down the price of Nordstrom last year with everyone else, we knew, because we followed it for so long, that they are painting the whole industry with the same brush, and they shouldn't. Those guys are not the same. And in fact, if anything, there's a very good chance that if Macy's dies, for example, and the industry shrinks, the player that remains, who's a lot stronger, may become the category killer. And so actually the weaker players and the shrinking industry may play to their advantage. I know there's no guarantee, of course, but the odds are that. And the company is priced as if it's going to die, like everybody else in retail. And so this is a special situation that happened because we followed the industry and are familiar with the landscape for a very long time. The third question on the issue of understandable. Yes, absolutely, understandable is objective. And in theory, my job is to deepen and expand the industries that I can understand. Either by developing myself or building a team that has better skills. Now, there are areas that I think we will never be able to acquire enough knowledge in. There aren't many, but there are a few where I think specialized knowledge is a must. Think biotechnology, for example, or venture capital. Or there are areas where you do need specialized knowledge. But we have expanded the industries where we've invested over the past. I mean, I've been doing this for 17 years now. The circle has expanded. What we want to make sure is, at the time of investment, we want to make sure that we are within the circle. That's all. And if we need to expand the circle, we basically do it offline. And if we're going to invest in a new industry that we haven't invested before, we scale down the investment just in case we're not expert in. 3 questions that we've combined into one here. What are the fund's future prospects in relation to the current global economy? The US market has gone up so quickly. Don't you think that it might go down at the same speed? If yes, how would you mitigate such risk? What's your view on the global economy and the valuation of the US stock market? To start with, I mean, we've said this before. We do not try to predict the economy, nor do we try to predict where the market will go. And the reason we don't is that in order for you to make money from such prediction, 3 conditions need to be met. The first condition is that you have to hold a differentiated opinion about, let's say, the economy. The second condition is your differentiated opinion has to be right. Now, these two together are extremely hard. The third condition, which also adds to the difficulty, is that you need to find an investment where you can express that correct and differentiated opinion in a way that fits nicely with it and makes money for you. And I don't think the three conditions can be met on a regular basis, if at all. And I do know that I do not possess the skills to do it. And so that's why we don't do it. Instead, what we do is we try to arrive at the macro from the bottom up. And so we invest in many industries, and we follow many industries and across geographies. And we get a lot of feedback on a regular basis from management teams of those companies. And we try to see what they're telling us. And we definitely do keep an eye on what's happening in every economy where we invested. But we don't use that knowledge to make predictions and make investments. We'd rather just be globally diversified and not have a strong opinion one way or another. One from here? Anyone from the back?
The result of the quarter, and
I don't think we have the quarterly number. We do have fiscal year to date, which is July and August.
all right, so it's annual. Now, my understanding is that there is a structural difference between the index and the fund. And therefore, the creation of result is attributed to the structural difference rather than circumstantial performance. Have I understood this correctly?
No, could you elaborate, please?
In the sense that, well, the index is an index. It's not huge, with too many variables and too many different performances, and therefore the performance and the fluctuation could be too up or too down. While the fund, because it's elective and process driven, the performance wouldn't have that much fluctuation. And in my mind, that is a structural difference. And therefore, this is not bad, this is nothing. That's how I understood it. And I asked just to ensure that I understood correctly.
I mean, by definition, I suppose,
Yeah.
every active manager holds a portfolio that is a subset of a bigger universe. We hold 20 to 30 positions. The MSCI World has 1,500 and something. Now, that does not necessarily mean that the 20 or 30 we own are going to be better or worse, more volatile or less volatile. That is a combination of selection, which is basically what we're paid to do, and luck, what ends up happening. So we do the selection and then luck happens, and either we do better, the same, or worse than we thought. The fact is, in terms of our actual performance, purely from a volatility point of view, our annualized volatility has been about 20% less than the market. But a lot of that is caused by the types of companies that we select and the valuation discipline that we bring to the table. But that's not something that will always happen to every investor. It just happens that our preference, and back to the question we got from the gentleman Yasser earlier about growth versus value, what we do ends up putting us in a position where we select companies that are probably going to be less volatile, even if the portfolio is smaller in terms of the number of names. But other active managers could end up selecting ones that are either the same. Some people actually target a portfolio that behaves generally like the benchmark and then try to differentiate in selection. We end up buying things that are, in this very strict sense, safer, if you use volatility as a measure. But that's not structural as much as just a byproduct of our style of investing. I hope that answers the question.
Yeah, it does. Thank you.
In the annual letter, you say that the market will drop by 20 to 30% soon, yet you tell investors not to sell their holdings. Can you please expand on that? I never said soon. I mean, the market is guaranteed to drop by 20-30% at some point. History tells us, if we take the S&P as a measure, the S&P has had a 10% drop, which people in the industry call a correction, on average once a year, and has had a 20% drop, which people call a bear market, on average every 3.5 years. And they've lasted roughly a year, more or less, but with very wide disparity in terms of length and how steep they are. Now, we actually did have a few drops of that magnitude the past 6 years. Last year, for example, 2016, running into end of Q1, early Q2, the market was down 18 point something percent on a 6-month basis, but then it recovered very quickly. There was a 10%, the year before that, 2015, there was a 10% drop, 2 hours. And then I think the week still ended up down about 10%. In 2000 sorry, I'm working off of memory, so I may just end up making updates here. But in 2013 or 14, also around early summer, we had a double-digit drop. In 2011, we had an almost, again, a 20% drop. And obviously the great financial crisis. It's normal. If there's anything that's guaranteed, is that it will happen. Now, history also tells us that trying to predict when it will happen is nearly impossible. Another thing that history tells us is that because of the wide disparity of how long those corrections or bear markets take, it's very hard to know when to come back in, especially because the first phase of the recovery is usually extremely steep. So yes, the drop is big, then you have usually a steep recovery, and some of them are real recoveries and some of them are not, so people are not sure they're going to come in, but in many cases you have a period of weeks to get back in, and if you're not sure, you end up missing the recovery. And by missing time on the upside and missing time on the way to come back, and this is shown in many studies, you end up usually, and people do end up usually, causing more harm than good by trying to time the market. Now, that does not mean you should ignore the question. Instead, what I would advise people is to prepare for this to happen, because it will. It may happen tomorrow, it may happen 1 year from now, it may happen 3 years from now. I have no idea when it's going to happen. I know it will happen. So, and I think the hardest part, and the part that you should prepare the most for, is the mental part of it. You have to ask yourself, and actually really sit with yourself, run through the scenario in your head. What would you do if the market dropped 10%, 20%, 30%? Do you have cash on the side that you may want to invest? Is there an amount of money that you have in the portfolio that you may need for something very important that is essential? You haven't put a down payment on a house or whatever it is. And in the case of a 20-30% drop, you may not be able to do that. You don't want to find yourself in a position where you sell after a 20-30% drop because you have another personal reason that you need the cash to sell. Instead, you want to position yourself so that when that happens, you're in a position to buy as opposed to sell. And so think of it, I think, and the more you think of it with yourself and go through your head, the better prepared emotionally and mentally you're going to be for when it does happen. Let's take one from here. Ramzi?
No, but to the point you were mentioning, the steep declines in the market historically were triggered by some fundamental reason that some skeptics on the side were seeing very clearly, but the market at large did not believe the skeptics. Case example, I mean, the internet bubble was one where the market was in euphoria, but many people thought the internet was just, I'm talking about 1999, 2000, of course, thought, it was just too overhyped and something's going to have to give. And then the crisis that we experienced in 2007 related to the leverage, debt, the underperforming debt, subprime being a main trigger. And again, there were a lot of skeptics, only in this whole group who sort of said something's going to have to give, but they were talking about specifics. They were talking about the internet being hyped, they were talking about subprime being a big issue and it's going to have to come and bite. Do you see outliers out there, and just curiosity, people who are saying there are specific triggers that could cause the market to correct in a big way, given where we are today?
This is a very hard question. I'm going to have to tread very carefully, not to break my rule of making no projections about the future. I think you are correct, definitely, in saying that the huge drops in the past have often coincided with macroeconomic events where something bad in the economy has happened. And by the big ones, I mean the 30, 40%, 50% type drops. There have been many 20% drops where there is basically no reason. And I think the two examples that you mentioned also highlight another factor, is that valuation is often not the reason for the drop. As I would argue in 2007, with the exception of certain areas, valuations in equities were not high. And definitely in 1999, outside of TMT, technology, media, and telecom, valuations were not high. In fact, what they used to call old economy stocks at the time were very cheap in 1999. Nobody wanted to touch them. And so in both cases, substantial parts of the market were either inexpensive or cheap, yet they still ended up, in many cases, at least temporarily going down, despite valuation not being a factor because of wider macroeconomic events. So I'll agree with you on that. Now, and then the other thing I want to highlight is that you also have a lot of 20% ones with no reason. The most famous one is the 1987 crash, where basically nothing happened. It's just, it's a random event that supposedly shouldn't happen except once in a, I don't know how many million years. This essentially ties to the first question about what keeps me up at night, right? I haven't seen anything other than people repeating that the same thing that happened in 2007 is going to happen again. Now, history tells us that crises usually happen not for the same reason that they happened last time, because everybody's focusing on what happened last time, but for no reason that nobody's paying attention to. And so the odds that you're going to have a crisis that's exactly identical in source to the last one, I think, is low. However, you can bet that there is always someone sitting somewhere doing something stupid. You can definitely bet that bankers somewhere are sitting doing something stupid. The balance sheets of banks have strengthened, at least in the US, substantially. They haven't in Europe. So that's a big worry. If Europe were to undergo a crisis of magnitude similar to one we had in 2008, the sector is a lot more vulnerable in reality than it looks. That being said, Europe is an early to mid-cycle recovery right now versus the US. So I think the odds of the timing of it are still, while difficult, probably are not soon. The big one is China. And there are a lot of structural issues in China in terms of the debt side of the basically China Inc. balance sheet, especially on the regional level. So a lot of the regional governments in China have borrowed substantially. A lot of it has gone into property development. And while the government has been able to at least temporarily deflate it the past couple of years, there is a risk that if growth slows down, the central government or the regional governments will have to push on the pedal more, re-inflating that potential, if not actual, bubble. Now, what will that do to the global economy, I think, is unknown. And what measures China as a government can do to deal with it is another question. But I'm just speculating now. That is a potential source of trouble, but that's a potential source of trouble that people have been talking about for 10 years. There are times where I felt that it's worsened and times where I felt that it's better. I'm kind of in between now, so I don't know. So that's the area that worries me in the grand scheme of things. But if the global economy kicks up a notch, especially with Europe now looking better than any time before. Europe has outperformed the US for the past year and a half now in terms of GDP growth. Now if they come back strong, then China may be able to grow itself out of the problem as long as they don't keep adding gas to the fire. And that's something that we're going to have to wait and see.
What about governments' bloated balance sheets? Because if you look at where debt has transferred to, if you look at consumers, corporations, and governments, a lot of debt has been now taken by governments by virtue of printing money and stimulus, etc. And it's almost impossible to see a U.S. government kind of defaulting on anything because of their printing machine. But Europe doesn't have the same luxury. They're taking on more debt. I mean, that's the mother of all disasters. Should it happen, we might as well go home.
I think history tells us that when sovereign borrowers have faced the question of whether to default immediately or default through inflating their way out of debt, they have chosen the latter over the millennium, or at least over. I would bet on that, time and time again. When push comes to shove, you're just gonna print money, inflate your way out of it, which is a very good reason not to buy sovereign debt at 1 or 2%. I don't think you are being compensated for that risk. Just because inflation hasn't happened yet doesn't mean that it won't. And unless growth picks up substantially, and I don't see the trend of growth long-term picking up, given demographic pressures in Western Europe and the US, odds are they're just going to inflate their way out of it. Slowly. So nobody will feel it, but they will if they have to. And I think that's probably where I would bet would happen. And I mean, yes, obviously the US can do it very easily with the press of a button. In Europe, it's slightly harder because of the Germans. But if things get really tough, I think they'll do that. I mean, they can always leave the monetary union and offer to pay you. I mean, Greece essentially almost did, They can pay you back in drachmas, basically, and you go try to spend that. I've noticed that over the past year, Mayar Fund data has started showing up on many websites, such as Morningstar, Bloomberg, the Financial Times, and the Financial Times. In addition to performance, these websites show other information such as peer performance and risk statistics. How much attention should we pay to these details in evaluating Mayar Fund or any other fund we may be interested in? with the caveat that I'm not a huge fan of risk statistics. I think they oversimplify things, and not all risks should be quantified. There is another reason why you should take these with a grain of salt. The FT, for example, lists Mayar Fund as the 4th or 5th best performing fund in the world. Now, I'd like to think we're good. I'm not sure we're that good. I can think of at least 6 people who are better than us. So maybe we're the 7th. But in all reality, we're probably top deciles. I think the issue in this case on the FT and Morningstar, relative to numbers that we've generated internally, is an issue of peer groups. A lot of these websites will use different ways to define the peer group. And so whether they're looking at Mayar Fund or any other fund, peer groups have the problem of being labels. And so I call myself a value investor. Some people may call me a quality investor, and the geographies differ. And so while they're great for marketing purposes, we're very happy that the numbers are out there. When you're evaluating funds, remember that the peer group is always or usually an issue. And so don't just look at it from a ranking point of view based on that. Let's take one more, but we're running out of time. Does anyone from the floor have a question, or should I keep going?
Just a simple question. Do you ever go through the penny stock pages?
The what, sorry?
The penny stock pages?
No, we don't. I mean, they wouldn't pass our first filter, honestly. Okay, I've seen several of your talks on YouTube and heard more frequent podcast interviews with you over the last year. Aziz, is this something that you are dedicating more time to now? And if so, what? I think part of our job as managers and as fiduciaries is to explain what we do. We need to explain it to investors. We need to explain it to a wider audience in many cases. And we try to do as much as we can through the quarterly letter. And sometimes a platform such as a lecture at a university or otherwise is also a good way of sending the message out. And it definitely helps for in terms of marketing. It doesn't take a lot of time. It's still not at a position where you should be worried. If you do see me on CNBC or Bloomberg every day, you should be worried. But we're not there yet. I'm going to keep going through the ones via email unless someone raises their hand, just in the interest of time.
Question is I was reading a book about the intelligent investor and mentioning that the bonds or cash should be 1/3 to 2/3 of your portfolio. Now, when I'm investing with you, do I consider that is being taken care of, or I consider it as an equity fully?
No, you should look at our portfolio as the equity portion, for sure. Yeah.
Without considering the cash
No.
portion?
Mayar Fund should not be all of your portfolio,
Yeah.
definitely. And arguably not even all of your equity exposure, if you have enough to diversify managers, or styles, for that matter. I'm going to skip this one. But we won a couple of awards. They're not Morningstar Manager of the Decade, and that's why we didn't make a big deal out of them. Okay, so this is an interesting question, and a very good one. I think many value investors have struggled in the past few years. Some have argued that value investing is dead. What's your opinion? This is a chart that we sent in the September 2016 quarter letter. I've just updated it with new data. Not much has changed. What it looks like, it takes the MSCI World Index, splits it in two. One half is the value, the cheaper side, and one part is the growth, the more expensive side. And it takes it since inception. And what you can see here is, with the exception of 1999, up until the global financial crisis, value has had a pretty consistent level of outperformance within a very narrow range, which fits in with other studies that have been done over the years on many geographies, going back in some cases for a couple of hundred years. Now, since the global financial crisis, this has stopped. And you see value underperforming massively and continuing to underperform. And there's a little blip off of the all-time low that it reached late last year, but you can still that we're way, way, way below trend. Now, we are not classic value investors in the sense that is measured here, but if you've read about the style of value over the past few years, it's been tough to make money, at least to outperform. There are many ways, many people have tried to explain this disparity, and last year in September 2006, I tried to look at it compared to 10-year interest rates and have shown and showed at least some correlation, though not necessarily causation, that in periods of low and decreasing interest rates, growth tends to outperform. And so as you had monetary expansion since the global financial crisis, interest rates have gone down and value has underperformed. I am of the opinion, although I'm willing to accept that I might be wrong, the interest rates will probably revert. And that if they do, this will help value outperform again. Now, we could still be in a situation like Japan was the past 26 years, where we've had continuously low interest rates. And in that situation, making 5 or 6% in equities may be a smart thing if interest rates are going to remain at 1%. But I think, in my opinion, the odds are this time is not different, and the spread will revert to the mean, and interest rates will go back up. But I might be wrong. My position on this is not extremely strong because historical precedent, especially on the interest part of the interest rate side of the question, is mixed. You mention assets under management in your letters regularly. Why should I, as an investor, care about the firm or the fund's assets? And at what size would you expect to close the fund to new investors? There are benefits and drawdowns to size. As you become bigger in terms of asset size, you gain a lot of economies of scale on the cost of running the fund. Administrative costs go down as a percentage, auditing costs go down, execution costs go down, custody costs go down, and so you do benefit. The cost of investing $1 in a 100 million fund is a lot lower than the cost of investing that same $1 in a $1,000 fund. That being said, there is another side to growth, where at some point there are harms to size. As you grow, the effective universe where you can invest becomes smaller and smaller. And if you run a $10 billion fund, you can no longer look at a $100 million company. You just cannot put any meaningful amount of money into it without moving the price too much. And so there is basically a happy equilibrium. Sorry, one more thing. On the benefits of size also, at the very high end of size, Warren Buffett size basically, you do have access to deals that would not be presented to you otherwise. But I don't think this question is relevant. That aspect is relevant to us right now. I think the more relevant thing is, where do we think the midpoint between positives, pros and cons is? I think our existing portfolio as it is probably scalable by a factor of 10 or so. So I think we can scale very easily to 500 million just by buying 10 times as much that whenever we make a decision. And our strategy probably can easily scale to $1 billion with very small tweaks. And I know that odds are at 10 billion and above, we'll have a very difficult time generating the kinds of returns that we've generated. Where is the cutoff between 1 billion and 10 billion? I have no idea, but my sense is that it's going to depend on the market environment. And so tying it to the second question, the question of closing the fund, I think obviously as we get to 1 billion, we need to revisit the question. Other solutions that people have and raised more money when the opportunity was there. And famously, Seth Klarman of Baupost did that several times. But we'll cross that bridge when we get to it. I'm just going to skip a couple of questions. This is one I want to address because I was asked a few times. The fund has added multiple share classes over time, especially this year. Why? And when will the fund start paying a dividend? Now, the share classes that we've actually added so far this year are purely for administrative reasons, and they have to do with distribution agreements such as the one that we have with Diraya. But from the investor's point of view, they're identical to the Class A and Class B. We just separate them in their own share class to make the administration and the accounting easier. One thing I'd like to remind every one of you is we have a prohibition in our PPM against giving any liquidity preference to any investor. And so no matter how many share classes we have, no one will have preference in terms of how quickly they can redeem or invest. And I think that's extremely important for us because that's the only way to be fair. On the second question, the question of the dividend, we've gotten this question many times. And again, tying to the question of size, we're now at a size where we can address some of these requests. And so beginning next year, probably in January, we're going to be issuing a share class that will pay a dividend. Now, this will be identical in every way to the A and B share classes, but will pay a 2% dividend a year. And the performance of the income share class will be, in terms of price, will be 2% less than the A and B regular share class. And so basically, essentially, we're taking 2% that you would have received in terms of price gain and paying it out to you as a cash dividend. And investors will be allowed to move between the two share classes and in whichever way they want, based on their income needs and cash needs. And we hope that this not only addresses this concern, but also in many cases helps people have a longer term view to their holdings in the fund. So we'll get back to you in terms of with details later in the year, but we'll probably start in January or at the latest in February in allowing people to move back and forth between the two share classes.
What did you arrive at the 2%?
Sorry?
What did you arrive at the 2%?
We pulled it out of thin air.
Fantastic.
Yeah. We just talked to a few people who actually suggested it, and that's kind of is in between. We could have actually taken an average and we probably would have ended up with 1.96 or whatever. But we just pulled it out of thin air.
Aziz, how much do you consider your fund to be exposed to a key man risk?
Oh, that's an excellent question. Now, in terms of the actual implementation of strategy, I am still the ultimate decision maker. And so despite the team growing, I still call the shots. We are nowhere near the position where someone else can take over and actually manage the fund on a going concern basis. That being said, we have a written policy that our brokers, our custodians, our directors, and our operations team and our administrator all have on file, and it details how the fund can be liquidated within a 90-day process in an orderly fashion, and the proceeds distributed to every investor at the NAV of that date. And so if I walk out the door and I get hit by a bus, you'll get your money within 90 days. That's basically the plan as it is now. We're not in a position where someone else can take over and run the fund for the next 10 years. We may be at some point in the future, but in my opinion, we're not there yet. But we have the infrastructure to guarantee that there is a smooth process to liquidate and distribute the proceeds in a very short period of time. We're running out of time, and so I'm going to skip over a few. I'm going to come back afterwards, but I want to leave you with a few closing remarks. I want to break after them so people can go and pray. There's a prayer room on the first floor, one floor above. But let me leave you with 3 takeaways. The first takeaway I want to leave you with is to remember that our success in the past, today, and in the future rests and will continue to rest on those 3 important pillars: our principles, our strategy, and our process. The second takeaway that I want you to take is that our approach has helped us not only survive, but also capitalize on financial storms, even ones predating the current fund in 2001, 2008, 2011, 15, and 16. And then the little third part, the third takeaway that I want you to take today, is that in a volatile and an uncertain world, we will continue to stick to our disciplined, long-term approach to investing. And one key component of that is to be both conservative and opportunistic at the same time. Thank you for coming.